Good morning, good afternoon, hello everyone. Welcome to Natixis Midyear Outlook. This is our now traditional event to try to discuss our forecast, our views going forward. So this is our Midyear Outlook. The next session will be in December. But for now, we are very happy to welcome you to this Midyear Outlook 2022. What we are going to do is to have three topics we want to discuss and exchange with you. First thing first will be around the macro picture, so around growth, what we say about the economies. We really like to think that we like not, but we think that we are very much heading towards some kind of stagflation. After that, we want to discuss energy prices. It seems to be very instrumental into the inflation picture. So we think it's very important to discuss what's going on in terms of energy prices, but as well energy transition. And we call this event lost in inflation, but we could have called this event lost in energy transition as well. So energy will be one of the big topics, and we end up with what to make out of it in a way. What's in it for me in terms of investment strategy. So we are going to discuss market, equity, asset allocation, rates, central banks, obviously, in the last session. So each session will be around 20-25 minutes. Each session we will try to answer as much as possible Q&A. So do not hesitate to use the Q&A possibility on the Teams. I will try to grab some questions along the way. So clearly, what we have in mind is that we are in the middle of it's not a perfect storm, but it's clearly one crisis, not after another, but on top of the previous crisis in a way. So we had the COVID crisis, now we have this energy transition crisis, and we have the war in Ukraine adding up to all this mess, plus China. We'll discuss at length China with Alicia in a short while, but clearly China is clearly on a sudden stop or still fighting with COVID, and we see that COVID is back as well. So it's very difficult to navigate this stormy waters in a way. So first view that we have is that COVID is not over in a way. It seems to be over in the US, it seems to be over in Europe. We have good vaccines working quite properly. People are used to it. We are not afraid anymore. So even though we have some variants, we see a new wave coming in Europe, for instance, but no one is closing up economy or anything like that. So we don't think it's a problem for Europe or the US, but clearly China was the first in and probably is going to be the last out of it. And it has a big impact. We will going to discuss that. The other input in our scenario is about what's going on in Ukraine. And our central scenario is the following, that we think it's there to stay for quite a long time. So even in the war is going to take time. It is there to stay because the Ukraine are putting a stiff resistance and they're getting more and more help from the West. So probably we will be able to fight back or at least to resist. So it means that sanctions will be there for a very long period of time. So I had a question from a client, are we going to buy some Russian gas at some stage going 2 years from now? Probably no. Probably it's a structural change to the trade, and probably that's a structural change for the world economy. It's probably the end of the globalization as we knew it. Definitely, we are going toward diversification, and probably I like what Janet Yellen is saying. We are going towards some kind of friendshoring in a way, more and more. So clearly, all this put together, stagflation in the making, energy transition plus the war in Ukraine adding up to the pressure to accelerate the sovereignty of energy in Europe or even in the US, but clearly it's more a subject for Europe, which is not independent and very much dependent on Russia, plus the fragmentation of the world. All this put together, we think that inflation regime is going to drastically change going forward. So it's why we think it's quite important to discuss the picture and what's going on in terms of inflation. So it's what we're going to discuss first with this macroeconomics view of ours. I'm going to be joined by our economists to discuss what's going on, and definitely we are in a kind of stagflation world. It's a very different situation from Asia to Europe to the US. Inflation dynamics are very different. If you take Europe and the US, that's a very different situation. In Europe, about 2/3 of inflation is coming from energy. It's not the case in the US. It's more classical demand side driven inflation. Maybe we're going to discuss that. But clearly, altogether, we are clearly in a different world in terms of inflation. So let's discuss this first, stagflation in the making, with our economist, the first workshop on macroeconomy. So, welcome back. I'm very happy to be with my three economists for all over the world. And you know, Natixis, it's a team of 60 people around, and lots of people in Europe, in Frankfurt, in London, in Asia, and in the US. We are about 20 different nationalities, so we are very, very happy to have a lot of diversity and viewpoints. But today we have the great pleasure first to welcome Alicia Garcia-Herrero. She's coming from Asia directly to Paris for this seminar. Alicia is a great specialist of Asia in general, but in particular of China, where a lot is happening. China, about 20% of world GDP, so obviously what's going on in China is very important for the rest of the world. I'm also with Dirk Schumacher out of Frankfurt and Troy Lutka out of New York to discuss the global picture of the economy. So maybe I start with Europe, and there's probably the center of the problem. Once again, lots of things are happening in China and the US, but maybe to start with Dirk out of Frankfurt. Dirk, where do we stand? Are we heading towards a recession in Europe for you?
Well, we're close to one. We forecast stagnation in the second quarter and then a rebound thereafter. But I must admit my confidence that rebound in the second half is going to be a forceful one is somewhat diminishing. The euro area economy at the beginning of the year was still doing okay, at least for European standards. But then the renewed supply chain problems, plus very high inflation rates that are eating into real income have clearly dented the momentum. We don't have data for Q2 yet, but it's safe to assume that after negative private consumption in the fourth quarter last year, the first quarter this year, also in the second quarter, consumption was again down. So a major driver of growth is actually not contributing at all. Business sentiment is holding up relatively well. Within the surveys, you see some areas that look not so great, but overall, companies seem to be doing okay, which to some extent is understandable because it's them who are doing the inflation, if you will, and they can digest inflation easier than households. But the side or the supply side bottlenecks obviously are not helping. And the general uncertainty about the outlook, the fact that central banks are now across the board tightening policy in a very meaningful way, or are about to do that, that is also not helping. So to answer your question, we're flirting with recession. It's not in our forecast, but I readily admit it doesn't take much to push us towards that direction.
So same question for you, Alicia. Are we going into a recession in China, or is it credible to see a big rebound with this infrastructure plan of Xi Jinping? He needs something, he needs good news. So is it credible to see a rebound of China, or are we in a recession mode as well?
Well, recession for an economy that grew 8% last year would be basically dramatic, wouldn't it? So we are in between those two scenarios. We're not in a recession mode, but we are in a sharp deceleration mode. The difference is that there's no such thing as stagflation in China because inflation remains very low. The reason for the sharp deceleration is mainly lack of mobility. This is zero COVID policies, although quite frankly, we were coming already in the second half of 2021 from a fast deceleration. So in other words, beyond the lack of mobility, there is also a very negative sentiment in China related to lack of income. So disposable income is growing very slowly since the second quarter of 2021. So it's a shock on top of a shock, as you mentioned. And down the road for the third and fourth quarter, of course, we will have a recovery, as you mentioned, but not the type of recovery that some analysts may be expecting based on the drastic announcements of stimulus coming from China's leadership for the reason you mentioned. Mainly, we have a party congress, which is absolutely essential for the leadership. But the V-shaped recovery can't be there because zero COVID policies are still in place. And we would need a humongous stimulus to kind of withstand the lack of mobility and what that means for the economy. So we are expecting 3.5% growth for the year, much lower than the target, which is 5.5%. And even getting to 3.5% is based on the assumption that no more lockdowns might come, which is a big assumption, because zero COVID is still in place in China.
And we see Omicron waves going back in Europe and the US, so we can't see much reason for that not to happen in China. Maybe same question for Troy out of New York. What do you expect in terms of dynamics in the US? Are we heading towards a recession in the US, technical recession, or is it still okay?
Yeah, it certainly sounds that way, or it certainly seems that way, judging by basically any indicator you could look at, either in the economic data or in financial markets. The Fed has obviously laid out some very aggressive tightening plans. You can already see these impacts on the housing market. Data in this sector are just falling off a cliff. Really doesn't matter what way you look at it. On top of that, you're also seeing this in the manufacturing sector. Initial jobless claims are up 30% since March. And the point that I would really like to stress is that anything the Fed does now, we're not going to know the full effects of for about a year. It's going to take about a year for the effects of Fed tightening to proliferate throughout the broader economy. We already have a ton of hikes priced in. Growth is already falling off a cliff, while inflation at these levels is highly demand destructive. So I'd say the chances of a recession this year are certainly better than 50-50.
And where do we see the US growth ending this year in Q4?
We have the US ending the year at 0.9% this year, with considerable downside risks. This is below the consensus of economists and below the Fed. The Fed sees growth at 1.7%, which is historically normal, but they're going to use that as justification to keep hiking. Their forecasts are not correct.
So we are kind of believe what Laurence Summers is saying, that unemployment in the US might reach 5%. That's something reasonable to think?
Yeah. I think unemployment north of 5% by early next year is certainly the mark to set your eyes to, for sure.
And you mentioned, Troy, the role of the central bank, probably very counter-cyclical, tightening in the middle of a decelerating economy. Where do you see the Fed going in this context of a deceleration? And in a way, we see a sense that the Fed is changing its view that fighting inflation is fighting a recession in a way, in the Fed's new mindset, because its inflation is denting into a purchasing power. So we kind of see that the Fed is considering that the more they're hiking rates, the better is it for the growth perspective. How do you analyze this kind of a new playbook by the Fed?
Yeah, the Fed, through all the communications and all the information they've given us, has basically said pretty plainly they are okay with throwing the U.S. economy into recession if it means bringing inflation closer to the 2% mandate. You can see this in their forecasts. You can see it in their statement. This is really a credibility argument or credibility problem for them. Inflation's at the highest level in 40 years. They were consistently saying that this is transitory. This is a temporary phenomena. They look pretty bad in the face of markets right now. What we see them doing for the rest of the year is we think they're going to go 75 basis points in July, 50 in September, 50 in November, before they're forced to pause at 0 in December. Next year, there's a very strong argument to be made that they'll be cutting because they over-tightened this year.
So they are not going to go, in our view, much beyond the neutral rate in a way?
Well, it depends on where you measure neutral. In our estimations, it's somewhere around 2.5%. But basically, everyone on the Federal Open Market Committee has stated that they want to go above neutral. They want to go into restrictive territory. Is that 100 basis points on the Fed funds rate? Maybe. But another factor to consider is what they're doing with the balance sheet, which in our calculations will add an additional 100 basis points of tightening. And that's obviously going to be a big problem for an economy that is already slowing quite sharply.
Keeping with you, Troy, where do you see and when, two questions in one, the peak of inflation in the US? Is it still, is it there or is it ahead of us?
That's really the million-dollar question. That really comes down to what happens with oil. Inflation, I think, will certainly have peaked by the back half of summer. I am pretty confident that it will come down faster than many analysts are expecting, considering that real disposable incomes are actually down 5.5% annualized thus far this year. If people are poorer, they spend less. If they spend less, firms have less pricing power to pass on to consumers. That whole chain of causality takes about a year. So people are getting substantially poorer. Inflation is going to come down a lot faster than people are thinking.
Interesting. Maybe the same question for you, Alicia, regarding inflation, because we see that in Asia. Japan is an obvious story into this, but where do we see inflation in China? Why there is no inflation in China compared to the rest of the world?
Well, there are two reasons for consumer price inflation to remain very low in China. The most obvious one is the lack of demand, and this comes because of COVID or lockdowns, but also even before. I mean, it's just that China is decelerating structurally, and we can see that quite clearly in the slowdown in retail sales from the jump in the first quarter of 2021. So since then, it's been quite dramatic. But the other reason is that prices are administered, especially electricity prices. So
everything is administered in China these days, no?
Well, yes, more than ever. So that helps basically keep inflation under control. But inflation for us, I mean, Chinese inflation shouldn't be what we should focus on the most, but rather Chinese export prices to the rest of the world, because what we want to see is whether there is basically export of inflation from China rather than export of deflation from China as we used to have in the past. And that's exactly what we are seeing. So because producer prices in China remain rather elevated, above 6%, part of that pressure is going towards the export market, which remains huge, is 1/3 of intermediate goods exported from China to the world. And that's where China, in my view, is leaking part of the inflation we're seeing. It's not all about energy. And that part might be more, I wouldn't say structural, but certainly more sticky, maybe, than even energy prices. So I think that's an important point to take into account when looking at global inflation dynamics.
Very interesting. It means that China used to be a deflationary engine of inflation in the world, deflationary input, and now it's becoming inflationary in a way.
Yes, if I may just add, the reason is simple. China before had to fight to obtain more market share. China now does have the market share, and in some domains more than ever after COVID. So that's why China can do now what China couldn't do before.
Yeah, they have a pricing power, not a monopolistic approach, but clearly a more pricing power than before. Maybe, Dirk, same question for you regarding Europe. We see inflation same as in US. In US we are at 8.6. Surprisingly, in Europe now we are 8.1, so very close to US levels in a way. It's something rare in history. So where are we heading in terms of inflation? Dirk, do you think we are close to the peak? Is it end of this year, next year? Are we going to see an acceleration of inflation with this famous wage spiral after IG Metall numbers?
Well, I would echo Troy, who said that it comes down to what energy does. So based on, in Europe, if you will, the energy component is even more important as a driver of inflation than the US. So roughly 50% of half of the inflation rate we're seeing comes from that. Based on the forecast of gas and oil we get from our commodity experts, we should be close to the peak now, and we should see a gradual decline. But of course, geopolitical developments can easily change that oil and gas dynamic again, and then you have a different inflation profile. When it comes to the underlying inflation, it has obviously picked up as well. Core inflation has picked up in a meaningful way. But it's a different kind. It's also here cost push driven. It's not like in the US where you had very strong domestic demand. As I said previously, consumption is actually down. So it's a different beast here, and therefore, as the economy slows, and let's assume that the oil price stabilizes and gas price stabilizes, even eases, we should see as well inflation coming down. Now, if wages were to pick up in a very sharp way and or inflation expectations were to get de-anchored and start drifting upwards, then we are again a different story. Latest wage developments are still within the historical range. And you mentioned the IG Metall wage claim, that is as well within the range. So they ask for 7 to 8, they get probably 4. Plus, if you then read the fine print, it's going to be even less because it's going to be distributed over a longer period of time. We just had a wage deal in the steel sector, the German steel sector, 6.5, sounds a lot. But again, if you look at the details, it boils down to a much more moderate increase. So this is no proof that, or no guarantee that we might not get a wage spiral. But for the time being, the data we have, coupled with the cyclical weakness, doesn't argue that we get a proper one, which would put core inflation on a totally different trajectory than what we are forecasting.
Since Dirk used to be the chief economist of the ECB, we had the internal model of the ECB looking at the wage story in Europe. What this model say? Because what we see, it's quite impressive. At the end of the day, we are the lowest ever in terms of unemployment rate in Europe, 6.8%. So, en passant, we can say that the unemployment rate in Europe, or including in France, is probably now lower than China. So, Dirk, one question: if we try to put some kind of a forecast for the wage increases in Europe, where will be your peak?
Well, we're looking at an acceleration to 4 to 5% in the coming quarters, which would be close or a bit above the historical peak we've seen in 2008. Now, a wage increase does not mean that inflation will increase by the same amount. To give you a rough idea, roughly a third of the cost of an average company in Europe is made up of wages, the rest other stuff. So it's not that higher wages will one-to-one translate into higher headline inflation. Not least as the economy weakens, the pricing power of corporates will decline. We have margin compression to some extent. Markups have been pretty high. They're probably going to be lower. So yes, there will be high inflation. We see stronger wage. That's why we forecast core inflation to stay clearly above 2% next year, which compared to a historical average from around 1.2 before the pandemic shows that we do indeed live in a different inflation dynamic. But it's not the kind of runaway inflation that would then force the ECB to be extreme in terms of rates. So we do expect 125 basis points of rates till the end of the year, but compared to the Fed, that's still moderate. And
Alicia, in China, do we keep seeing some kind of acceleration of wages, or with this rising unemployment in China, above 6%, do we start to see some deceleration of wage in China as well?
Yes, wages have been decelerating in China since 2012, slowly but steadily. But that deceleration has basically fastened since 2018, because China is coming from, again, as you said, crisis after crisis, or at least shock after shock. And the trade war was already dampening China's growth on the back of already a crisis in 2015. So wages have been decelerating quite dramatically. We don't see it so clearly on the wage data, because that's kind of the official sector, if you see what I mean. I mean, there's a huge amount of employment in China that is not in that data point. You need to look at disposable income, and that's where you see a clear deceleration. That's worrisome for China's move towards a more consumption-based economy. We wonder how China is going to manage that now.
Interesting. Maybe a question for you, Troy, the last round of questions for you guys. What is the main risk for you, for the US economy, for the incoming quarters, Troy?
It really has to be the Federal Reserve and really what happens with energy. If energy continues to rise, that's going to give the Federal Reserve a license to tighten even more aggressively than they've intimated currently. That risks a pretty serious disruption in credit markets. It's important to look at default rates. We have in the United States an economy built on 10 years of extremely easy monetary policy. A quick reversal like we've seen is not going to be smooth. So really, the key factor is what happens with oil in my mind.
And do you think, Troy, that a big sell-off in equity, in pretty much everything, and we see a tightening of financial conditions that we have not seen since 2008 in the US, do you see that as an excuse for the Fed to pause, or it's not going to happen before they go a bit above neutral rate, as you said?
Yeah, it's going to take some time. They're going to need to see something break, so to speak. You're going to need to see a pretty sharp rise in the unemployment rate. You're going to need to see default rates rise. But the canary in the coal mine that I think they're going to be paying very close attention to is what happens with credit spreads. If those begin to blow out substantially, then, and only then, I think will they consider really taking their foot off the gas.
In 2 seconds, Troy, in terms that's a midterm, mid-year outlook. In terms of midterm election in the US, is it a risk of having a kind of it's very popular in France these days, a kind of a blockade of the budgetary policy?
Can you repeat that exactly?
With the midterm election in the US, is it a risk of having no more budgetary stimulus whatsoever, whatever happens with energy prices and so on?
Yeah, so, I mean, the midterm elections, on average, a president, 2 years after he comes in with a mandate, they lose about 30 seats in the House on average. On top of that, you see a number of really vulnerable Democrats in the midterm elections. So you're likely going to see, a Democratic president along with a Republican-held Congress. That's going to mean there's going to be a pretty significant logjam of legislation, which means, additionally, you're not going to see any fiscal response in the event that there's a crisis. So which means that in the next crisis, it's likely going to be a lot more like 2008 than it was 2020. You're going to see a lot of monetary potentially with very little fiscal stimulus.
A question for you, Alicia. What is the main risk for China going forward? It's not the midterm election. It's probably...
Yeah, there are no elections in China. Well, there are internal elections, but that's the whole point. We thought there were no elections. We thought it was a done deal up to February this year. So now the party congress becomes news. People didn't even talk about the party congress because it was just to ratify basically Xi Jinping's, if not absolute or illimited number of terms, actually at least a third term. The only discussion was, is it a third term or is it, a permanent white card basically to remain. And now what we don't know is whether he will remain. And I think that the question is, although the probability is not very high, but the question really is, how does the rest of the Politburo evaluate President Xi's role in as regards Russia's support, and as well as, of course, zero COVID policy. So there's a lot of things changing. I think this is a huge, to me, it's more of an economic risk. In other words, I don't think, it's very unlikely that we'll see a change, but in between, we probably will see a paralysis of that stimulus that we referred to, meaning that the recovery will be weaker than we thought, and his starting point in that third term will be harder than we thought it would be.
Is there a risk of kind of what we see, like you said, China supporting Russia, or not supporting, but clearly being on the Russian side for in many ways? Is there any bigger risk for Taiwan, you think, if we had to put some kind of probability? I know it's very difficult to forecast.
I think the risk of an event in Taiwan, because, the risk of reunification is not, this is a different type of risk. It's not a risk, it's possibly something that eventually will happen, in my view. But the thing we should focus on is what's the risk of either military operation, following Putin's nice words, or actually a blockade. That's another possibility, a blockade in the Straits. And that depends on the US, to be frank, how much the US pushes for, a tense situation that could also be related to the US own political agenda. It depends on Taiwan's elections in November, because we could see again, very likely, another green government, so basically pushing away from China. And again, Xi Jinping's results, because the harder it is for Xi Jinping to rule, or the more, given the economic situation, the more of a chance for Xi Jinping to think about nationalism as a different tool to obtain his objectives.
Okay, so watch out, tighten your seatbelts in November, because we have the Communist Congress Party, the midterm election, plus Taiwan election, okay. Okay, we'll see. Last question for you, Dirk, the same question. What is the biggest risk for Europe going forward?
Well, it has to be an energy embargo against Russia, an immediate. Of course, some form of embargo already in place, but when it comes to gas, I think Europe is still quite vulnerable. Seems that Putin is trying again to increase the pressure here. I don't think he, from his side, the Russian side, want to cut off gas. He rather doesn't want that the reserves will not be filled completely, such that during the winter there's a continuing dependency and vulnerability. But you never know, and the Europeans could decide to cut it off. So that's the main risk. Quantifying how much that would hurt the economy is difficult. We've done some rough calculations, came up when it would have happened in the second quarter with something like -2% on impact, i.e. the sequential growth would be 2% lower, which is significant, obviously. And now maybe half of that, given that reserves have been filled, and obviously we reduced somewhat the dependency from Russia when it comes to energy. And the other risk factor would have been fragmentation, i.e. the fact that peripheral spreads widen to an extent that it would endanger the recovery in these, or the economy in these places. But the ECB has made clear they don't want too many crises at the same time. So that is not really a risk anymore. It begs a couple of interesting medium-term questions in terms of how the monetary union functions, but in immediate future, there's no risk anymore because of that. And I think it's a credible promise. And all governments are in principle on board, because there's no good other answer than what to do other than having the ECB take care of that.
And in terms of anti-fragmentation, what's your take about being a former ECB guy? What's your take about this new scheme soon to be announced?
Well, I think it has to come one way or the other, simply because OMT, which would be the alternative, which Draghi back then in 2012 invented, seems not palatable, seems not a realistic option. And again, given the geopolitical context we're in, nobody wants a big political economic crisis in Europe now. The instrument, there's still a lot of problems that have to be ironed out, how to do it. There will be legal challenges, no doubt about that. But that will take time, and the instrument will be announced in July. That's what they said. They have to put it on the shelf, and hope that they don't need to use it then. But it's going to be part of the, making sure there's no accident in the short run.
And that will be probably less stigmatizing any country and probably sterilized in terms of liquidity injection?
There has to be some conditionality. I think otherwise it would be too blatant violation of the European law if there's no conditionality whatsoever. And if it's targeting at specific countries, but that could be a very light one, which is politically acceptable, and the liquidity might be sterilized like it was in the S&P. Why not? We still have excess liquidity, abundance of that. So that doesn't really change the picture much if they sterilize or not.
Okay, I think time is ticking up on this first workshop. So thank you very much, Alicia, Dirk and Troy for joining this session. So you can see there are lots of challenges going on in this macro picture that we are all experiencing. So just as a kind of a wrap up, lower growth for sure, with some probably risk on the downside, especially for China, but as well in Europe. Dirk mentioned it. If we have a full stop of gas imports from Russia, that will be probably close to 1 point less for close to 1 point GDP growth for Germany. So half of what we expect for now. So clearly, risk on the downside when it comes to inflation. Probably it's going to be a new regime. So talking about inflation, we are going to discuss the energy prices, because I think Dirk mentioned it, the bulk of inflation in Europe is still inflation. So we're going to discuss the dynamics in terms of energy with the next topic. So, lost in transition in a way for this workshop. I'm very happy to be joined by Joël Hancock, our oil and gas analyst. Well, I missed a little bit of self-promotion, but Joël has been around the top 3 worldwide in terms of forecasting TTF and gas and oil. So very quite interesting to hear what he says about the future. We have as well Bernard, very well ranked in the forecast. Bernard Dada is our specialist on metals, especially lots of subjects here. And we have Ivan Pavlovich joining me as well. He's one of the analysts working on green transition and one of the greatest specialists in France, if not Europe, in terms of hydrogen. So I'm very happy to have you guys on board. So maybe starting with what hurts the most European economies these days, oil. So what do you think of oil? Is it going to, are we seeing the peak already of oil, or is there any danger of what we hear about the embargo from Europe, but we see that it's going both ways. So what's your take on oil and then on gas?
Yeah, sure. So the macro themes that were discussed in the previous session clearly eroding oil demand at the margin. But really right now, the oil market is overwhelmingly supply driven. So you mentioned the embargo, and that's really the key trend. So we have an embargo agreed, and it's coming into force by December 2022. And carve-outs have also been agreed for Central European countries that are landlocked, have no other alternative to Russian oil. But pipeline flows via the Northern Druzhba pipeline and also seaborne imports into Europe are going to be under embargo. So we think we're going to lose about 2.6 million barrels per day from Europe's energy balance. But the key question for the market is this oil just going to be lost from Europe, or is it going to be lost from the global market? So really it's a question about rerouting and how much Russian oil can actually clear to alternative destinations. So when we look at seaborne exports from Russia since the invasion, we've seen several countries really increase their imports. So India, for example, has gone from about 40,000 barrels per day to 700,000 barrels per day. Big increase in Turkey as well, a small increase in China. Now, we think this is going to continue. And effectively, this is because these EMs are essentially undergoing an energy crisis. So benchmark prices spiking, the higher dollar as well is leading to just major stress from the energy import side. So if Russian barrels are available for a cheap price, we do think they'll continue to flow. So we think net will probably lose about 1 million barrels per day by December 2022. But in our balances, we think this is manageable. So when we do look at our demand growth assumption and we look at that 1 million barrel per day supply loss, we think the deficit is manageable from existing inventory. Now, if we do look at higher supply loss assumptions, so maybe a 2 million barrel per day loss, it's at that point we think you're going to have to rely on demand destruction. And that would need an oil price about $140, $150 per barrel. But with our base 1 million barrel per day loss assumption, we're looking more like 110, 120.
Very interesting. And what about the gas? Can we make it without Russian gas this winter, or do we have to fear some disruptions of cuts in terms of gas? Are we going to get cold this winter, you think?
Yeah, I wish I had an optimistic answer to that, but I do think the events of the past week are really a game changer for the European gas market. So we had, first of all, the Freeport LNG outage, so initially expected to be 3 weeks. Now as full operations won't be back until the end of 2022. So that one plant was supplying about 10% of Northwest Europe's LNG. So that's one thing. Then we also saw the cuts to Nord Stream 1, initially from about 150 MCM per day down to 100, and then subsequently lower to 67 MCM per day. So a major cut. Now, our base view is that we're not going to see a normalization of flows via Nord Stream 1. So really Russia has been, in effect, limiting its export options So there's options via Poland with the Yamal pipeline, and also cuts have been made to the Ukrainian transit as well. So the majority of Russia's flow to Europe has gone via Nord Stream 1, and now this technical issue to Nord Stream 1 is effectively, it's the worst case scenario.
It's a kind of a weaponization of gas from Putin. Every time the TTF was down to, I don't know, like 85, all of a sudden we take this opportunity of the visit of Macron, Draghi and Scholz to Ukraine to drive price up. Do you think there is kind of a weaponization of Putin these days?
We don't think that Russia is a reliable partner in the gas trade going forwards. So being diplomatic about it. But prior to the Nord Stream 1 cut, Europe was well on track to fill inventory to the 80% level that's been mandated by end October by the European Commission. This cut now means that Europe is going to struggle to build at that level. And when we do think about the gas weapon, it is in effect an option with significant time decay. So we're going to listen to Ivan talk about the longer-term transition away from Russian gas, and that's been publicized widely. And so if the economic damage from Russian gas is going to severely impact Europe's economy, it's only really going to be this summer and the next winter where that's going to be kind of a major driver. So our view is that we're not going to see this normalization of Nord Stream 1.
Yeah, well, obviously he has to move now. He has to make his move now as the stocks of gas are still around 55 in Europe. So if you wait for October and you have 80% of village of gas, it's not going to work. So maybe that's a good transition for Ivan. And if you have some question for Joel or geologist, do not hesitate. Use the Q&A. Ivan, in this context of probably as Joel mentioned, we are going to head for, we are heading for trouble in terms of energy in Europe. Are we going to see at last a big acceleration towards transition to more renewable energy, or at least alternative to carbon energy? Thinking of REPowerEU. Is it credible what we are seeing in Europe these days?
It is credible because, as Joel mentioned, it's turning mandatory to face a potential outage of Russian gas supplies in the coming years. So through the REPowerEU plan announced by the European Commission last May 18th, what we see is a sort of overarching plan to get rid of Russian gas supplies as early as 2027. And obviously this plan is underpinned by a series of measures which will accentuate all the energy options embedded in the Fit for 55 package announced by the European Commission last year. So basically, it is turning mandatory to accelerate the deployment of all renewable energy sources, obviously renewable power, but also biomethane and renewable hydrogen, which can be seen as one easy substitute for gas, particularly Russian gas, in the coming years in the industrial sectors like chemicals and refining, which are badly in need for gas in the coming months.
As you said, we need to be in the new European rules to be at 45% of renewable by 2030. But how long does it take really to get to cleaner energy, you think, in terms of magnitude, timescale?
Well, it's a sequenced approach, keeping in mind that, for instance, in the very short term, Europe will have to rely heavily on coal to substitute for gas in the power generation sector. So obviously, it takes time to build or deploy new renewable capacity. And obviously one of the elements embedded in REPowerEU is a series of measures to standardize the permitting approach across member states to make renewable capacity deployment easier and quicker across Europe. So it will clearly take time. As you know, permitting can last up to 4 to 5 years. So clearly we have to go much quicker than that to make much for the lost Russian gas in the coming years. And
probably turning to Bernard now, all this put together, we need a massive acceleration and a massive transition towards new energy, roughly moving from 80% carbon energy to 80% electricity. And for that, we need a lot of commodities, which are metals. Yeah. Are we going to have enough metals in the world? Is the existing stock enough to think of this major transition Ivan just mentioned?
Yes, it's a very good question, because when you look at a lot of those electrification points, it's like an EV requires 3.5 times more copper than a normal car, 25% more aluminium than a normal internal combustion engine car. So the energy transition, the backbone of the energy transition is base metals for photovoltaics, for wind farms, etc. And the problem we've had over the past, I would say, 7-8 years, so you can see that chart on the left hand, is that basically there's been severe underinvestment in the mining sector because prices weren't interesting enough, weren't high enough. And there's like a 5-year lag between when miners stop investing in output to when you start seeing output drop, actually, or stagnating. And that's what we're starting to see now, that's, for instance, in the copper industry. So yes, prices have increased now, but we haven't been investing for the past few years. So even if the miner now decides to increase output and says, I'm going to invest everything I can, it's going to take him 5 years for that output to materialize into more output, if you want. So this is where the problem is, that demand is rising much more rapidly than the pipeline of projects that exist in mining. Now, the second question we're often asked, is there enough metal out there in the Earth's crust to meet demand between now and 2050? The answer is yes, there is. You look at the known reserves and you do the maths, and yes, there is enough. The big question is, at what price? So it's going to be, you're going to have higher prices to incentivize output of those minerals, because they're harder to reach, they're more expensive to reach.
And we all learned about, obviously the whole planet is now turning into a renewable alternative to carbon for again, energy transition reason, not for the sake of the war in Ukraine. And so we see something like around cobalt. For instance, Tesla is using much less, I think it's 3-4 times less cobalt than it used to. We have seen a joint venture between Renault, Valeo, using batteries without rare earth. And so we are moving fast in terms of technologies as well. But we know for a fact that, for instance, lithium is going to stay in high demand going forward. So I don't know, over the last 2 years, probably it's up by 7-fold or something like that, lithium. Do you expect prices, metal prices, such as lithium, to keep being at this kind of attitude?
So the recent events right now have shown us that in the short term, it's the macro field that dictates prices. And we've seen the slump in the drop in aluminium prices. We're at 2,400, we were at around 3,000. Copper prices is today 8,900. So we're seeing prices across the board, the base metal board, retreat on the back of the fear of the recession. But our point of view is that this will be temporary, that we are going through a super cycles of commodities relating to the energy transition. So we'd expect for prices after this, if you want to call it recession, but after this economic slowdown, to start rising gradually again, and that prices will for the next probably 10 years will be in a super cycle basically for base metals.
Does it make credible or realistic to see some new plants or new mining in? We hear about Nevada opening new lithium mining, or even in Portugal, in Europe, even in Spain, I think.
Yeah.
Is it credible, realistic to see some new digging in Europe or in the West?
Yeah, I mean, there are plans for that. It seems that in Serbia, for instance, they tried to open a lithium plant, but there was, basically people rejected it. So there is the problem of the population not accepting, still not accepting to have mines on their terrain. So that is a big issue, especially with Europe trying to wean off Russian commodities. They're going to need more and more to mine within, I would say, within Europe to be able to achieve that energy independence. But there's another point which Ivan could point out to, but like a country like in Europe, which is weak
on base metals, on metals in general, mining in general, well, they've got the hydrogen option, which makes them kind of be relatively independent from, let's say, China, which is now ruling basically all of the metal pretty much most of the metal that goes into electric vehicles, especially in Africa and other countries.
And before moving to hydrogen, maybe another question for you, Bernard. In terms of recycling of metals, we hear a lot about this kind of a solution in a way for Europe to say that, well, okay, we are paying the high price now, but as long as we are going to get enough stock of batteries or stock of metals, underlying metals in Europe, we will be able to recycle it and maybe less, not independent fully, but more independent. Is it something, again, credible, that?
Yeah, it's kind of like more and more there's focus on recycling, and it's been something in the industry that's been going on for a while. So for instance, platinum or palladium, 35% of those metals comes from scrap, from total supply. But I think for this energy transition for the next 20, 30 years, we're going to still need primary demand. But I think that going forward, recycling is going to gain much more prevalence, and it's going to appreciate much more. The companies are going to appreciate much more, just because the lower carbon footprint of recycled material, especially with CBAM coming in Europe, is going to make recycled aluminium or recycled copper much cheaper to import, let's say, than primary copper or aluminium. Just for an example, aluminium from scrap is 98% less carbon intensive than primary aluminium. So that in terms of lowering your carbon footprint, you've got to add as much as you can of recycled material.
Maybe moving to hydrogen, we hear a lot. It's a kind of a solution, more independent, more lots of. There are some pros and cons as for everything. But is it credible for? Is Europe back in the game in terms of hydrogen? Is it leading the pack or way lagging behind? Or do we stand in Europe and how credible is green hydrogen? Once again, green hydrogen is in terms of alternative to carbon energy.
Well, from a technological standpoint, we can say that Europe is leading the game. We have lots of pioneers in the field of equipment manufacturing, electrolyzers, fuel cell vehicles. So clearly, from this standpoint, yes, we can say that Europe has taken the lead. Now, when it comes to supplying hydrogen and making hydrogen affordable for its final uses in heavy industries or heavy mobility, this is a different story because, well, obviously, production costs for hydrogen for the time being for renewable hydrogen are very high. So there are basically two options under the table. We basically improve domestic supply across Europe, and you have to incentivize the development of electrolysis capacity as well as renewable energy. Renewable nuclear power being also an option, but not the preferred option from the European Commission to power these electrolyzers. And obviously, scale effects eventually should turn or should bring production costs down to a level making demand for hydrogen sustainable. And the other point, and this is also something that is part of European Commission's REPowerEU, is to increase imports. So basically, in 2030, according to REPowerEU, Europe should be supplied with 20 million tons per annum of renewable hydrogen, 50% of which would be domestic, 50% of which would be imported. And obviously, what you see is trends towards the introduction of long-term contracts between the EU and potential trade partners in hydrogen. It could be Australia, it could be Saudi Arabia, it could be Namibia. All these countries have huge ambitions to export hydrogen, leveraging their high solar and wind production capacity and obviously their available land. So these two elements adding up, there are clear trading partners for hydrogen. And obviously, if we were to see, if we expect to see hydrogen taking off in the next years, we need this cheap hydrogen to fuel demand and to make it affordable for these uses I mentioned, heavy industries and heavy mobility.
In terms of mobility, you just mentioned, what do you think is good, or mobility and usage, in fact, of hydrogen? What's your view in terms of where we're going to find hydrogen going forward? Probably not individual cars, but what's the use case for hydrogen?
Well, you're right, Jean-François. Hydrogen is unlikely to take off for individual cars in the next years, but for heavy mobility, that's a different story. We're talking about, for land mobility, trucks or buses. And for the maritime transport and the air transport, we're talking about the potential use of methanol, which is a derivative of hydrogen for maritime transport. And for the air transport, the situation is a bit difficult for the time being because fuel cell development in aircraft is still at a very early stage. So theoretically, by 2035, we should be in a position to use hydrogen to run fuel cells to propel aircrafts. But for the time being, the preferred options from airline companies is to use an increasing amount of sustainable aviation fuels, which is obviously a derivative of hydrogen and carbon from capture sources. So with this, you can see that hydrogen enjoys a huge potential in this, in these transport subsegments, but obviously not necessarily in its primary form as a derivative or, combined with other feedstock.
Very interesting. We start to have some question. Maybe in terms of a question for you, Joel, there's a question about how long do we have in terms of rebalancing out of Russian gas? Because if I read you the question, what kind of time decay period are we looking at for Russian gas? Does it not hinge on our ability to pivot to renewables? So question for you more than.
Yeah, so really, I mean, the biggest point we think about our ability to actually completely replace Russian gas on the supply side, at least, is looking at new LNG terminal capacity. So at the moment, really, we're in a bit of a desert of new liquefaction capacity entering the market. So we had huge capacity additions in 2017, 2018, 2019, which really oversupplied the European gas market. Now, from about 2020, that input has stopped, and we're not expecting to see more capacity come online until early 2025. So on the supply side, at least, there's a limited capacity to really compete for LNG cheaply. And that means that the available LNG that is on the market is going to have to be essentially taken away from emerging market economies in Asia and demand destruction in Asia and in Europe. And so in the near term, at least, it's going to be more demand-side substitution, so biomethane, as Ivan mentioned, but also in the short term, perhaps demand-saving measures like insulation, things like that.
Can I ask maybe another stupid question on my side? Because is it really much a solution to invest in LNG, which is more emitting carbon than the classical gas, and it takes, like you said, 5 years to get there? While, I don't know, maybe a question for you, Ivan or Bernard, how long does it take really to get solar or photovoltaic? We see in Germany, for instance, photovoltaic central producing 650 million megawatt-hour made up in just 1 year. So is it possible to move from LNG to renewable energy in a shorter period of time?
Well, one of the interesting things with LNG terminals is that they can be built in such a way as to be hydrogen ready. And for instance, in Germany, you have 2 LNG terminals under construction, which are meant to be hydrogen ready, which means that at some point they will be slightly retrofitted in order to substitute hydrogen for natural gas. So that's also one way to make things reversible and avoid, I would say, any carbon lock-in from the perspective of the energy transition.
Because building up on the question here, that we see that LNG and even more nuclear, that's probably a long-term solution, but short-term solution, if we have a sudden stop in gas, we probably need to find alternative. Like you put it very nicely, it's a demand destruction, which means a recession. We are back to the first thing. So maybe we stop here as time is ticking up. Very interesting. Thank you guys very much. So as you can see, there are lots of challenges going forward in terms of energy transition. Probably in the short, medium term, it's an inflationary story. But most likely in the longer run, if you think of photovoltaic or wind energy, with the marginal cost of that is closer to zero. So it's probably deflationary in the long run. So very interesting transition period as well. So I'm not sure we are lost in translation, but we are clearly in the middle of it. So thank you very much. We move now to the third and next panel, which is around the markets in a way, in terms of asset allocation. What do we make out of it? Next session on markets. Welcome to our new colleagues. So I'm very happy to have our strategists, the team of strategists around this table. So starting with Ina Mufteva, our credit strategist. We have Guillaume Martin, our rate strategist. We have Nordine Nam, our currency specialist. And on top of that is our specialist on digital currency. So good luck to Nordine. And we have our senior asset allocation specialist, Florent Pochon. So lots of things to discuss. Maybe starting with you, Guillaume. Maybe on central banks, and we discussed this a little bit in the first panel. But where do we see the market compared to our own forecast in terms of terminal versus neutral rate? Where do we see the market compared to what we think?
Well, there are basically two forces which will help us answer this question. The first one would be, of course, inflation. As we said, it's driving the steepness of the money market curve, and you also have the growth thematic, which drives the tilt of this money market curve. And what has been quite clear with the latest roundtable is that the pendulum swings way more heavily towards the inflation thematic, which means that we are likely to continue building up market expectations when it comes to central banks. So we are not at peak central bank expectations. We expect it to happen over the summer. And even if the central banks under-deliver, it's likely to continue building up. So we are expecting the ECB depot at 75 basis points this year, with 150 basis point hike in September, which is 50 basis points under the market. And when it comes to the Fed, we are expecting another 75 basis points for July. And then, as Troy said, two more of 50 basis points, which is just, when we look at the end of year, 25 basis points under the market. So we're quite close, catching up to the market, if you will. And when it comes to the money market curve shape, we are likely to see something similar in Europe to what we see in the US or in the UK, meaning that we will start to build expectations above the neutral rate, whatever that is for the ECB, which is another interesting question. But we are likely to see this kind of tilt in mid-2023, even after.
We talk about this feedback loop between decelerating GDP growth and accelerating tightening condition by central banks. What about long-term rates? Is it going to, where do we see long-term rates, and what kind of effects it could have on the economy is quite obvious on many aspects. But what do we say about long-term rates in Europe and the US?
Yes, of course, they are likely to continue rising. So if you are looking for a reprieve in the sell-off, it's maybe not the good time for it, but there are many components explaining this rise. The first one would be, of course, higher central bank expectations, as we said, but there is also the term premia, which are likely to be created, and Florent will maybe expand a little bit on this later after, but they are likely to be higher simply because financial conditions are starting to get tighter. With the balance sheet size decreasing in the US, we are looking at roughly 1.5 trillion reduction towards end 2023. So it's something quite measurable. And measurable. And when it comes to Europe, there is also at the end of the TLTRO, even if it's not really leading to big repayments, we are likely to see less excess liquidity, more pressure on spreads. And as Dirk said, even if the ECB this time is quite committed to lower the pressure on the spreads, we are likely to have the BTP bonds over around 200 basis points, but it's likely to get wider again by the end of the year, because 2023 is the year of general election in Italy, and it's likely to be quite something, which will lead to some pressure on the spreads. When it comes to the numbers for treasuries and bonds, we are expecting a peak for the treasuries between 3.75 and 4% this summer, and then we are likely to see the beginning of a rally. As Troy said, the Fed will likely have to stop by year-end, and the market will continue to front-run it, so it's likely to drive some kind of a rally. We are expecting the 10-year at 3.5 by year-end, and on the bond side, we are looking at 2.2 with a slow and steady rise due to a more progressive approach by the ECB.
Do not forget that you can use the Q&A session again along the way. Last question for you, maybe Guillaume. We are in mid-year. That's the whole purpose of this seminar. What is the key things we need to watch or to look at in the second part of 2022 for you?
Well, of course, the first one would be inflation, which would lead to the question of where the terminal rate is and its volatility. This is something also really important because if you have a central bank which is not that credible and you start to have a lot of terminal rate volatility, you are likely to create some risk premia on the curve. So it could have a very strong effect on the shape of the curve. You have also the possibility, as Troy said, if we have a quick deceleration in inflation, the possibility to have a strongly inverted curve, and this could also pose some problem to the Fed. So it's the first thing we should look at. The second one would be to look at medium-term inflation expectation. When you look at the 5-year, it has been rather steady as of late, maybe less in Europe, but it's still on chord. Yeah, it's still within the central bank mandate, with the central bank target band, if you want. And this could change if the inflation dynamics do not allow for a quick soft landing towards the central bank target. And this could lead to even higher real rates. If you look at the 5-year, for instance, in Europe, you are at 75 basis points, which is quite a lot compared to what it was 6 months ago. But if you look back 10 years ago, historically, it was 100 basis points above. So even if you have way bigger balance sheets for central banks, it could land somewhat higher than what it is right now. And the last one will be, of course, the financial conditions. We have seen tremendous volatility, be it realized or implied. You have really market functioning that has been quite impaired for this month. And this is something the Fed and the ECB look at on a very regular basis, which could switch gears and bring to a higher than anticipated pivot for the central banks.
Thank you, Guillaume. And indeed, we do not see much of a flight to quality these days with this rising repricing of everything. So a question maybe for you, starting with you, Florent, in terms of risky assets. In a way, we see that the flight to quality, usual flight to quality assets are going up. Like you said, 3.5 and 2.2 for treasuries and bond at the end of this year. Is it time to buy back equities, risky asset, or is it a falling knife we don't want to try to catch?
Well, I like it would be time, but it's not time. I think we're still heading towards a lot of difficult times for equity markets and more generally for risky assets. 2 reasons for that. We haven't changed really opinion. The first risk is really real rate risk. So Guillaume already touched upon that one. we had a massive correction, which was basically the anomaly of the post-COVID world, the correction of real rates higher. So we had 150 basis points higher of interest rates, real interest rates. So just keep in mind, again, this is something we've been writing a lot in our publications, 50 basis points more in the US, all things being equal, is 10% of S&P down. So we are somehow not there yet.
Even in the middle of the road.
We're not there yet. That said, again, we had a lot of, let's say, bubble-like assets or frothy assets that have been suffering a lot. SPACs are down more than 50%. IPOs are down more than 60%. Crypto also, all the very meme stocks also. So all the, let's say, the fancy and juicy stocks back there are now killed right now by the increase in interest rates. But so the effect is probably not full-fledged right now. And the second element why I think real rate risk is still there is that, again, we still may have some further repricing. Again, just keep in mind, Guillaume talked about the five-year forward. Just look at the 1 year forward short-term interest rates in the US, both in the US and in the ECB, it's still negative if you look at the market pricing of terminal rates. So this should not be negative. It should be at least to zero or above zero. So I just believe that the market somehow is in between, and there's still some room for further increase in short-term interest risk. This is the first risk. The second risk is, of course, what has been outlined in the macro panel discussion, especially by Troy, is recession risk. So recession risk will clearly go up. Troy said it was 50-50 right now for the end of the year. If you look at the market pricing, it's interesting right now to see that the pricing is clearly uneven. Equity markets are pricing in much more strongly. The VIX also, the slope, it depends on the metric you use. But you will see here two big anomalies, which is the earnings of the equities, which has not started to be revised downwards for the moment, which is clearly unbelievable and credible. And second is credit. So I still believe that the credit has still more downside, but I think Ina will talk about it. But if you look at high yield spreads at 500 basis points right now, if you think about recessions, it's more 900, 800, or even 1,000 basis points. So still some repricing there to be left, to be done. And so I still believe that you have to be defensive, and I still expect some more downside on the equity markets, at least through the summer.
And then, well, very clear, it's not yet the time to go back to the market. But what will be the trigger? What will be the signal, in a way, to buy back the risky asset?
Well, I think it's easy to say, and after it's going to be more complex, obviously, to find in real time. But I think it's as usual, I guess. There are three triggers to watch out. The first one, of course, is a macro trigger, so you can call it inflation decrease, as the Fed is looking at a start of downward trends. It could also be the pivot of the Fed we're expecting for next year. This, of course, could be the big trigger. But this should not come alone. You should have two other elements in my mind. First, a very weak valuations in risky assets. This is not exactly what we have right now. If you look at the slide, you can see that, of course, equities are much cheaper than they used to be, of course, 6 months ago, but they're not that cheap. At least if in the US, if you look across all our valuation metrics, you're still above the median levels. So you're not that cheap in the US. You're a little bit cheaper, but you're not super cheap in Europe, neither in the emerging. And the last point you have is positioning. You should have a very weak, or let's say, capitulation positioning. We started to get weak positioning towards risky assets, but it's not there yet. Again, equity long shorts have been cutting significantly. All the gamma players, which are CTA, risk parity, with the rising volatility, have been cutting positions. But still, there are still some deleveraging to be done much further, especially if you look at long-only investors. So we are not in the capitulation zone yet, and we have to have a conjunction of these three elements. Again, macro catalyst, very weak positioning, and very weak valuations. Until you see that, you have to be to keep the difference.
Cautious and patient. Yes. Okay, thank you very much, Florent. Maybe zooming in on the credit market, Ina, we see slowdown, less central banks support. Is it a perfect storm for credit? Florent mentioned that we need to be very cautious on the risky assets in general. What about the credit market?
Well, yeah, definitely. 2022 is going to be one of the worst, if not the worst years for credit.
Stay with us, stay with us.
For credit market for quite a long period of time. Just for comparison, the total return on credit was down 14% year to date for the investment grade. On average, for the past 10 years, we were around 3%. And the worst year in the past 10 years was 2021, and it was at minus 1.5. So just compared to minus 14, what we've got year to date so far, and you've got a picture of what it's going to be probably at the end of the year. And why? Because it can get even worse than that for two reasons that we already have been spoken for quite a while. Recession risk, obviously, and central banks, ECB in particular. So credit is particularly sensitive, in fact, to the central bank tightening. The flow effect is probably going to dominate the stock effect. What I mean by that is that since January 2022, ECB bought around 23%, equivalent of the 23%, in fact, of the primary volumes, and we'll have to replace these purchases by someone else. The problem is that there will probably be no one who will go instead of ECB, because credit is not probably the hottest spot right now, and the appetite has been quite moderate, or even more than moderate, quite modest for credit markets. In the past months, we look at the primary market, for example, with the much lower volumes of issuance, much higher premiums, much lower rates of subscription. We look at the credit funds flows, for example, IPFR, so in the US and the European side, everything is down quite significantly. For example, in Europe, so the IG funds are down 17 billion in net outflows, which means that inflows were actually lower than outflows by 17 billion, which is quite an important figure. And yeah, just for the high yield, to give you a figure, it's a 6. It's a bit less, but well, it's still a significant one. So definitely, performance of credit is going to be much negative.
Do we have any targets for the end of the year?
In terms of spread, we still expect some widening, although a lot of widening has been already in the market. But we think it might still widen by 20 basis points for the IG in euro, and around 50-60 basis points for the high yield.
And in terms of default rate, we expect, I guess, in this kind of environment, not a normalization yet, but I guess some increase in default rate?
Yeah, actually, we're at the beginning of the road. So definitely there will be some wave of downgrades. We already start to see it in the first quarter of 2022. We've got more than 115 downgrades in Europe. Rating drift stopped improving in Europe, well, not in the US yet, but in Europe already with the Ukrainian war. And it's going to continue. And also the latest data on the default rates proves, this trend. We are at close to 2% for Europe, so it was up, and around 1.5 in the US. Certainly, it's still quite low levels compared to the long-term averages of 3.5 and 4.5 for Europe and the US, respectively. But we are going to go up significantly, and we're going to take 1 percentage point for Europe, and 2 percentage points for the US in 1 year in default rates.
Thank you, Ina. Turning to you, Nordine, regarding the FX and currencies, a few questions on my side. Do you think the dollar has peaked, or are we going towards parity, or is it going to strengthen for the euro?
In fact, the dollar reached a historical high. And when you look to the DXY index, it's already at 2020 high. And when we look to in terms of real effective exchange rate, it reached also a very high level. So it's a good question to know. And And we expect the dollar to remain quite strong in the short term, at least, given that the dollar has been supported by the Fed, but also by risk aversion. And global uncertainties will remain high in the short term in terms of inflation, in terms of slowdown in China, and of course, all the earnings season in July. So we remain still positive for the dollar. But after that, we expect the dollar to decline by the end of the year on the back of US growth, weaker growth in the US. And the fact that also in July we will see many more US companies complaining about the strength of the dollar. It has been the case, and we will see more and more talking about this problem. So we expect the euro dollar to increase by the end of the year towards 107 or 108 on the back of a higher rate from the ECB. So yes.
And depricing from compared to the market in terms of dollar rate. And is it something cooking for the emerging? We see a lot of tension regarding emerging, but is it a 1994 style taper tantrum in a way cooking or different?
When you look to the details about hard currency emerging debt, they declined since the beginning of the year by 18% compared to almost 16% for the US Treasuries. So, and when we look to local debt emerging, declined only by 8%. So the decline is not so important. And even if you look back to 2020, the decline has not been so strong. But anyway, when you look to details, you can see that some emerging debt declined quite a lot, like all the Eastern countries declined quite a lot on the back of a strong inflation, 15% on average on all the CE countries. So maybe this debt will remain under pressure, at least in the medium term.
I have now a $1 million question for you regarding the Bitcoin. Where is it heading for you? Is it $1 million or zero for the Bitcoin? Where do you see the Bitcoin going forward?
The trend is still negative. We expect the Bitcoin to remain in a range between 12,000 and 19,000 on the back of a further liquidation, and particularly if the stock market remains on a downtrend, the correlation is still positive, even if it declines. And there's still some lack of confidence now, as many protocol and has been on the decline, and many cryptocurrencies have been freezed, so will remain quite negative in the short term. Yes.
So now we know for sure that cryptocurrencies are not a good hedge against inflation. That's for sure. Is it? You said there are lots of liquidation and a problem of in the ecosystem in a way. Is it a Lehman moment for the digital world? Not the digital, no, backpedaling. On the crypto world, digital for sure it's not, but for the cryptocurrency world?
No, for that you need a link with all the banks, and when we look to all the money purchased by all the institutional, now it stands to around almost $30 billion, so it's quite weak compared to, of course, 70 billion at the peak last year. So it's quite weak link in a way. So we don't see a moment, Lehman moment. But anyway, we should see a further decline of some companies.
If not defaults.
And default, it has been the case already for Luna, for example. But Celsius, which is a lending protocol, is under pressure. But not only Celsius, and we will see maybe other protocol under pressure in the incoming weeks.
And probably regulators are going to have a closer eye into this kind of thing. Even though you said it's not probably systemic in this kind of a crisis. It's even for individuals, it's probably not systemic. So maybe. If you have some questions, now is the time. We are approaching the end of this seminar. So long story short, regarding the market, is a bit like the big story, the big picture macro. The macro picture is it's lots of uncertainty in a way, and we need to be very cautious. So it's not very sexy in terms of asset allocation, in terms of targets, because we are kind of on the cautious side, as you can see, regarding growth, regarding central banks. we think we are not going to deliver that much, at least not what is all priced by the market, given what we say about the growth profile. But in terms of investment, given all this, it's going to be quite challenging. So we wait on the sidelines, if I can summarize the big picture like that. I cannot see any more questions, so thank you very much for joining us. We will be back in December for 2023 Outlook, so please join us. We have a lot of way of communicating with you. We have a Twitter account. We have the Natixis website, researchnatixis.com. We have as well the podcast, more and more podcasts on our SoundCloud or in our YouTube channel on called YouTube Natixis. So please do not hesitate to see us live through that. But more importantly, do not hesitate to reach to us for discussion. We will be more than happy to try to answer your question, if any. Thank you very much for joining us. Have a very nice day and see you in December. Bye-bye.